We need to talk about the major moves happening in the market. The S&P 500 broke below 5100 as big tech led the sell-off. Despite geopolitical tensions, global leaders chose not to retaliate, and so markets started looking towards the incoming data, and better than expected retail sales sent markets lower. And while this does tell us the consumer is in good shape, what does this mean for the inflation narrative? So today we're going to talk about the consumer and how they're holding up in this economy. We're also going to be talking about earnings, and despite the headwinds today, we got a lot of good news from financials. So as the S&P 500 starts making its way to key resistance levels, let's talk about what happens next. Do we bounce and go higher, or do bears finally get the sell-off they've always wanted? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. Now this is the daily heat map, a very red day across the board, a very upbeat in early hours trade, pre-market trade. The S&P 500 up nearly 1%, powering a lot of those gains in the afternoon, led by technology, Microsoft, Nvidia, Apple, Google, Microsoft, Amazon, Tesla, Visa, MasterCard. All of these stocks, the big names, the big boys, the heavy hitters in the index, were all down upward of 1% plus. And we're starting to see some early signs of a rotation. Now we'll get into the sector analysis a little bit later, but we have a look at stuff here. Certain names in consumer defensives, right? Look at packaged foods, very green. That's a bit concerning. Look at telecom services, right? A defensive sector right here, part of the shut index, which is staples, healthcare, utilities, telecom services. Then we also had some of the bigger names, United Health and healthcare plans, outperforming the broader market as a whole. And so we are starting to see a bit of a defensive rotation, but we do know that earnings is in full swing. Have a look at SCHW, Charles Schwab, in the undervalued portfolio. We're going to talk about their earnings. Morgan Stanley, Goldman Sachs, right? They're doing really well. They reported upbeat earnings for the most part, and that's why they're up. And this in turn helped banks for the most part, especially with the amount of carnage they saw on Friday. But all in all, a very red day across the board. Gold right here, GLD, the best performing, I guess, sector for the day, or commodity for the day. So definitely up 1.87%. That's really putting a lot of pressure on the market as a whole. And you could see that when stocks really started to go down was when gold started to rally in this afternoon trade, sort of around 1 p.m, 12:30-ish. But all in all, we do look at the market and we're still seeing overall liquidation, just people trying to pull money out of the market. Because look at the number one performing sector, down 0.2%. Look at then metals mining, right, down 0.24%. And then we have regional banks down 0.39%. We are still seeing liquidation in the market, as in just investors want to get cash, want to put it in a money market fund. You know, they're scared of the inflation narrative. And we look at the sectors at the top, GLD, XLV, XME, KRE, XLP. Okay, maybe excluding regionals, it's more defensives, it's more inflation hedges, metals mining. So the market getting jittery here at the top. GDX did lose, so you can definitely see, despite what GLD did, GDX was down. And yeah, it is an equity liquidation we are experiencing right now. Just the market doesn't want to hold stocks ahead of higher inflation, because what happened in 2022, 2021 after that massive sell-off is still fresh on their minds. The worst performing sector was software. A lot of this had to do with what happened in Salesforce CRM. They were down 7% on acquisition news. I'm not going to dive into the details. And then technology was down 1.9%. Then we also had XLRE and home construction down 1.65%. And real estate continues to get absolutely hammered as rates and yields continue to rise. And that's the reason why we sold off today. The fact was, at midday, gold decided to pick up. That sent yields flying midday too, on the back of a hot consumer spending report, and this saw continuation of downside flows. Now, I wouldn't put too much weight into the consumer spending report. I mean, the retail sales data came in pretty hot, don't get me wrong. However, the market actually rallied on the top of the retail sales report, and we also got a lot of the data in the MasterCard spending pulse survey day, it's a very good barometer for what retail sales is going to do. So a lot of this was priced in. A lot of the downside action came from a rise in yields, gold, and just continuation of downside flows. Momentum brings momentum to the upside and the downside. All right, guys, there's no two ways to spin this. Equities are coming under pressure across the board. I mean, look at the S&P 500, right, down 1.2%. Look at the Nasdaq, look at the RSP, down 0.86%. So the broader market did actually outperform the market cap weight, and that goes to show that it was just the bigger names that really did put in a lot of the selling pressure here. We're looking at Apple, Microsoft for the most part. Then mid caps down 1%. The S&P 600, so higher beta, still outperforming for the most part, but yeah, brutal day in equities, more so in growth than value. And if we actually just pull up, like, let's say a daily chart on something like the ES, you can see that we have this big wick candle right here at the top, and that's because we had quite a bit of buying pressure at the start of the day, and all of that got reversed, and you're looking at a peak to trough drawdown that was pretty brutal for the most part. Now, the main reason for that was just bond yields, right? Gold rallied on the day, and then bond yields followed gold. In other words, they went higher, which means bonds went lower, as you can see right here on both the short end and the long end. And actually after hours, they're experiencing a bit of weakness as well. So, overall, bonds were down 0.6%. Look at the longer end, down 1.55%. And the same was met in high yield and corporate bonds for the most part. Bitcoin continues to decline 4.2%. And we saw crude, still hovering here. I did say that this is going to be our interim top for a while, the $87 and $90 area. And that seems to be the right decision. We actually went ahead and made a lower low here on the daily chart in crude. The dollar gained ever so slightly, and I have no idea where this is going. Ideally, the next level of resistance here is this 106 level. But let's actually hop on the S&P 500 and talk about everything. Firstly, this is the daily chart. We're not going to look at the weekly or monthly. There's no point. It's the start of the week. And we could see here that we have broken below the 50 daily moving average. At the same time, the advanced decline line, the ADL line, has moved down. In other words, more stocks are declining than advancing. And below this 50 DMA, the truth is, guys, at the end of the day, there's no way to spin this. We are in a daily downtrend. You could see here that we're making lower highs and lower lows at the same time, breaking critical levels of support and breaking above the 50 daily moving average. Now, a couple of things we do have to note, right? I did say on my weekend video that a key level I was looking at was this level right here, 49.80 to 49.20. Now, in my weekend video, I did say a very key level I was looking at is pretty much from like 5,000 to 49.20, right? The actual figure was 49.80, and we're getting very close to that level. And I still reiterate that as a very crucial line of support. And I do think that we're probably going to get to this level here in OPEX. Friday is OPEX options expiration. And normally what happens is when we are in a negative gamma environment heading into OPEX, the window of weakness doesn't actually become a window of weakness. It then becomes a tailwind for equity. So if we find a bounce here after OPEX, that would be well within what normally happens in the quote unquote window of weakness. And I actually put this on Twitter. I said that the likely path for the S&P 500 is 5,000 at or near April OPEX, and then we're going to rocket up. Remember, guys, we're only looking for opportunities to add to long exposure on short-term weakness. The trend is up. We are in a bull market, okay? We're only down 2% from the highs. And actually, I gave you guys this game plan here in March. I said, this was on the 21st of March. I said, in the next 1 to 2 weeks, we're looking for a buyable dip to add exposure to our current long trades. We may get another buyable dip in April. History shows us that the momentum factor is seasonally negative in April if Q1 is greater than 7%. So this is exactly what we're seeing. This is going exactly according to plan. We're getting this buyable dip in April, and hopefully this keeps dipping to the 5,000 level and maybe even lower. Now, I will keep you guys updated on this if it does change, but as it is right now, 5,000 and to as far as 49.20 is the buy zone for this current cycle. And also, let's just measure this peak to trough drawdown really quick, okay? 4%, guys. We're down 4% from all-time highs, and people are getting worried. It's perplexing to me. Bears are celebrating on Twitter. It's kind of crazy, but this is where we are right now, and this is the first level of support I would look at to buy. I think we're definitely going to reach this. I think we're going to see continuation of downside flows. Sure, we could get a bounce tomorrow, maybe a little bit of a bounce and then continuation to the downside here, but I think we are going to see further downside flows this week with strong support here at the 49.25,000 level. But let's actually hop on the 5-minute chart just to see what actually happened on the day, and you can see we actually did have very upbeat action. The market wasn't hindered by the retail sales data. They actually like that. That means strong consumer, strong economy, and that was one tailwind for equities today. But after we made the high, we couldn't break Friday's high, and then we just made lower highs all the way down, and then 0 DTE buyers came in right here, and it wasn't even a strong tick upwards. And this probably means that until we go ahead and break, I would say this level right here, 5119, right, we probably are going to go lower. I think sellers are going to come very aggressively into any dead cat bounce that we get over the next couple of days and sell us lower until probably OPEX, until we have a lot of that negative gamma roll off the tape. But as it is right now, guys, we are in a daily downtrend. Do take that into consideration, and you do want to sit out the volatility. There's more downside going to come, but at the end of the day, we are in a bull market. Look at this chart, okay? You look at this, bullish. That is bullish. This is a very, very bullish chart. This is the last, from there, this is the last year. 1 year worth of price action. We're up 38%, 32% in the last year. That's very, very bullish. That's exactly what you want to see. And we just want to be looking for opportunities to add to long exposure, because we are going to go much higher in the S&P 500. Now, guys, the weekend poll just wrapped up, and absolutely crazy. I have never seen this many people bearish. 60% of people in the bear camp. I think that's the largest weekly bearish poll ever. Only 28% is bullish, 13% is neutral. And I am gonna laugh so hard if we finish green for the week after all of the bearishness we saw this weekend with the geopolitical tensions heating up. Now, guys, let's talk about earnings. A big week of earnings. We got a couple of big names here on Monday. We're gonna look at Charles Schwab earnings, mostly because it's in the undervalued portfolio and it's one of the stocks on the chopping block. So let's see how they did in earnings. Now, Charles Schwab reported EPS of 74 cents on revenues of 4.74 billion. It was a marginal beat. Total new assets missed, however, at 88.2 billion. The market wanted 91. Bank deposits missed as well, 269.5 billion versus 270. Total client assets was a positive, up 20% year over year to $9.12 trillion in assets. That is nutty. And new brokerage accounts was 1 million. So you could see that earnings was very mixed. It came in line, beats here, misses right here. And the market reaction was fairly muted pre-market. It was down about 1.16%. And I guess that's what you would see with this type of earnings right here. I guess the financials were right, but some of the underlying metrics that make up the business didn't fare so well. Stuff like bank deposits and total new assets. And this right here is kind of concerning because it could mean that Charles Schwab is actually losing market share to companies like Robinhood. Obviously, you know, total new assets is really how companies are able to extract fees from clients, and really this is the growth driver for the top line in the overall business. That being said, revenues did come in better than expected. I would give this earnings about a 5 out of 10 here for Charles Schwab. I'll need to dive deeper into it to see if it's going to stay in the undervalued portfolio, but overall not bad, not great, middle of the road. So let's talk a bit about the macro, guys. So this is a chart here from BofA showing nominal GDP well above the 25 trillion mark. I think we're sitting at about this number right here, 28.3 trillion. And both say strong nominal GDP. Surprise if EPS can't surprise to the upside. So pretty much the strength that we're seeing in GDP should really be reflected well in earnings. And we've kind of been seeing that. US profit estimates are rising. This is according to Bloomberg. A city index showed upgrades are outnumbering downgrades in the last 3 weeks. You can see here that upgrades outnumbering downgrades, and that's very, very healthy to see coming from what was a very choppy period so far in 2024. And we've definitely see that reflected in earnings. Earnings have so far been very, very positive, although we've had less than 50 companies report earnings, so it's not a huge pool of data to go from. That being said, the initial reactions are looking good. Now, let's actually talk a bit more about the consumer. We got retail sales data today. So the headline month-over-month figure came in at plus 0.7%. We were expecting 0.4%. The core figure, which is excluding autos and gas, came in at 1.1%. The market was expecting 0.5%. And this right here just adds on to the inflation narrative. But you do have to understand something, that when these numbers released, the market was actually very upbeat on them. That's because the market already had this data because of MasterCard's spending pulse. According to MasterCard's spending pulse, which measures in-store and online retail sales across all forms of payment, total US retail sales, ex autos, were up year over year in March 2024, showing continued growth for both online plus 6.1% and in-store plus 6.2% of retail sales. Examining individual retail verticals, MasterCard SpendingPulse found that total apparel sales climbed 5.4% year over year, led by a robust e-commerce growth, which was up 16.1% for the month. What does that say about PayPal, guys? The top growth vertical for the month was electronics, overall sales increasing 8.7% from March 2023. The consumer so far looking very strong, at least according to data that MasterCard gives us. At the same time, looking at tax refunds, today is tax day, and 2024 refunds have slightly surpassed 2023, but are still tracking aligned with the average. And a lot of the time, this money does make its way into the market. What we see here with April seasonality is that this right here is tax day, and then we normally get an acceleration from about the 16th to the 19th of April. And this probably means that people have more money, they have a bit more spare cash, and they're going to put that cash to work. And a great way to do that is just by buying stocks. And that's why we often do see this ramp up year in seasonality in the month of April. At the same time, even though the consumer is strong, relatively strong, what we are seeing is that small business optimism is at 11-year lows. So there's quite a divergence between what the consumer is feeling and what small businesses are feeling. And I think this has to do a lot with cost pressures that can't really be passed on to the consumer, that businesses have to absorb. And while stocks, these larger companies, can pass those costs on, small businesses can't. And that's why we're seeing small business optimism at some of the lowest levels it's ever been in the last decade. And this divergence can also be seen in the stock market. Large caps are pretty much near all-time highs, and small caps are still 15% plus from all-time highs. Now, looking at another measure for the consumer and small business, and really a barometer for the economy as a whole, is US rail traffic. This is the latest data, and you can see that on a year-to-date basis, we are up 9% in intermodal units, total traffic up 2.5%. That's a very positive development versus 2023. At the same time this week, total intermodal units up 7.6%, total traffic 1.6%. And rail traffic is often a very strong barometer for what the economy is going to look like 2 to 3 months down the track. And things are looking very strong here in US rail traffic. Guys, looking at gamma, negative gamma remains very elevated, and the gamma flip is still at this 5200. It actually moved down ever so slightly. It's now at 5185, so it is moving down the tape as we get a lot more negative gamma and as price does move lower. That being said, negative gamma pales in comparison to positive gamma, and it does look like for now there's going to be a lot of volatility all the way to at least the 5,000 strike. And that's what I'm thinking. We probably travel downward to the 5,000 strike until OPEX have most of this gamma roll off, then see where it rolls up to or rolls down to, and then from there make decisions based on what's going to happen for the rest of the year. But can't deny the fact there's a lot of negative gamma in the tape right now, and that just means there's going to be a lot of volatility in the market to the upside and the downside. Let's talk about seasonality. This is a very interesting chart. This is essentially S&P 500 performance from the 11th of April to the 20th, when the first quarter of the year was positive, but March 31st to April 11th was negative. Essentially, what are the returns we can expect using this criteria during this time? So the signal triggered right here, and it's very positive. You can see that normally we have 14 up years, 0 down years, so it's a perfect record. Average return 1.62%. So the current market conditions are very favorable for a bigger move to the upside. So if we do see a rally this week, despite all of the fear, uncertainty, and doubt, don't be surprised. History says that we normally do get very positive returns this time of year with regards to this criteria. Now, guys, let's actually talk about geopolitics. Now, for the most part, any impact on the market tends to be very short-lived. This is S&P 500 around military invasions and conflicts, and you can see here that normally on average 24 months later we actually do get outsized returns anywhere from 5 to 10% in the S&P 500 on average. This is skewed by a lot of downside we do see right here, but we can get returns, 24 months later, upward of 30-40%, and that's great returns in the S&P 500. So, if stuff like this, if we do see a short-term pullback, just consider it short-term weakness. For the most part, the market does shrug this off, and we do continue higher in the S&P 500. Now, something I do want to point out. Now, this is data from last week. It's not this week's data, but despite all of the selling we saw last week, new highs actually did beat new lows by the narrowest of margins. In the NYSE and the Nasdaq, there were 461 new highs and 459 new lows. New highs exceeded new lows for the 12th week in a row ever so slightly, and this is just a tick for market breadth. Breadth is still strong, and even though it was by a couple of points higher, it's still higher nonetheless. And if we do want to see continued downside action, we want to see new lows beat new highs, and we just haven't seen that on a week-to-week basis just yet. Now guys, in a few days the Bitcoin halving takes place. It's happening on the 20th of April, and we've had 3 halvings in recent history, and this is generally what happened 30 days after. You can see here that in 2016 Bitcoin was down about 10% after the halving. In 2012 and 2020 Bitcoin was up 7% and 14% 30 days after the halving. So the halving is generally seen as a bullish thing. It just halves the amount of Bitcoins that are delivered to miners for processing transactions. It just means that miners have less to sell on market. The price goes higher, supply demand imbalance. That's really the whole point of Bitcoin. It's part of the attractiveness of Bitcoin. And while this isn't a lot of data, we can generally say that yes, Bitcoin does tend to trend higher after the halving, and in general it does go to all-time highs after the halving. How do we know? Because we've made an all-time high since 2020 here in Bitcoin, which would ultimately be higher than the 2016 high and the 2012 high. So just something to note for those of you that are Bitcoin bulls. The halving takes place, and this is the data right here. Very interesting. Now, data guys, in this week ahead, we have housing starts, existing home sales, we have empire manufacturing, building permits, initial jobless claims. So there's quite a bit of data this week, but the main focus is going to be on earnings, and we do get some of those parameters, stuff like TSM, ASML, which are parameters for the semiconductor industry, as well as Netflix for the tech space as a whole. So the big focus is going to be on earnings, but there is a couple of big data points with regards to stuff like existing home sales and industrial production. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.